A model for this that has been used outside of finance is in environmental taxes. And so we can think of what's been called a carbon tax. Carbon is a pollutant, it harms the environment. And so one way of regulating this is to tell those who would emit carbon to say, well, there's only so much carbon you can emit. You're given a limit on how much carbon emissions you may have. But another way of doing this would be to say, well, you can emit however much you want, but you have to pay a price. Now, why would the tax on carbon be better than the limitations on carbon? Well, one is, again, the tax raises revenue. The government can actually have a revenue source from it. Another reason is that by imposing that tax on carbon producers, they can decide for themselves how much carbon they should produce. They have the same kind, it's like they're buying an item of any other input. And so going back to the financial institutions, that if the financial institutions, if there was some kind of activity that maybe exposes the economy to some kind of risk of harm, but maybe at the same time is producing benefits for the overall economies, well, the financial institutions could then decide for themselves how much of that activity they want to pursue. So in theory, the idea of a financial sector tax could have a beneficial effect the same way that a carbon tax could.